trades right here in ET now, and unfortunately the closing trades aren't headed in for a good Friday. 250 points lower still. Just a very slim recovery is what we've seen. In fact, from that gap down start of 1%, we've only worsened from there. And look at the pre-market rates for the US futures as well. The Dow lying flat with a negative bias, flat for the S&P futures, and the Nasdaq futures as well have eased off from where they were earlier in the session today. Oil, of course, continues to bob around that 120 odd mark. Brent is still at 123, so that doesn't really help the situation at all. Rajat Sharma from Securities as well joins in on the show right now. Rajat, hi, afternoon. Have you been a buyer in this current decline, Rajat, or are you just sitting out and waiting for the poison to get out of the system?
Good afternoon, Aisha. So, broadly, we've been sitting out, and the only couple of stocks that we've added more of is, the stocks that I spoke about last time I was with you: Coal India, ONGC, ITC, and essentially energy stocks. And as I said last time, consumption I think is a theme I've really started liking since markets have fallen, and these are companies where raw material prices going up could be passed on to the end consumers. So companies where there's no debt and companies can pass on the increased cost to consumers, basic goods companies, that's a sector which has started looking attractive. Having said that, as I said, broadly, I've still been sitting out because, to be honest, if you look at why the markets are falling, I am, in my mind, clear that the reason is primarily the interest rate revision upwards. If you think about it, from February 2020 till May 2020, interest rates were revised down from about 5.15% to 4%. There was an overall, so credit became cheaper by 22%. Keep in mind the year before that, from August 2018 to about August 2019, they were already reduced by 17% from 6.5% to 5.4%. So in the last 2 years, but in the last 4 years, from August 2018 till about March 2020, interest rates were back up to 40%. And since August 2018, we've not really seen any revision upwards in the interest rates. That's almost 4 years. And now with the credit cycle turning and interest rates going up, just like markets didn't immediately go up within a week after the interest rates were revised down, it took a year for markets to rocket up to about 18,600 levels on the Nifty. You will see in the next 6 to 8 months as the interest rates keep going higher, markets will continue to struggle. And in this backdrop, when you look at macro factors, there's nothing else that you can point to which could stem this fall, because inflation is still a concern. Raw material prices are high and inflation may come down, but for the next 2-3 quarters, margin pressure will remain on the company. So corporate earnings are not going to improve. Ukraine-Russia war does not seem to end, and this gives OPEC nations even more power to control oil prices. The demand is growing and the supply is controlled by these few OPEC nations. Russia, the second largest producer of oil, is obviously banned from supplying to most countries. And high crude oil prices can never be good news for India. So at a macro level, no matter how I look at it, I can't really reason why markets will go up substantially from this level. So broadly, I've been sitting out, and I made this point for about 8 to 10 months now.
Okay, broadly sitting it out, as you flagged off, there's so many factors that seem to be troubling the markets, and we'll have to wait and watch as to whether anything incremental comes in order to change the mood of the markets. Staring at a big cash in trade today, 16,222. Meantime, Rajat, what would be your outlook when it comes to LIC? Continually pounded day after day, the shares now are staring at a relentless cut of 9 straight days on the trot, where it's a far cry from the issue price of 949 apiece. Fundamentals are strong, and a lot of analysts had said that it's a quality stock to be in if you have a risk appetite for the long haul. Is that assessment now getting challenged to a certain extent, given the way we've seen the stock price fall?
No, I can only talk of myself and how I've looked at it. And I think we covered LIC. I was there on the show a couple of days before LIC IPO was to open, and I said, I'm very, very negative on this stock. Because, I don't know how you look at fundamentals, but from my perspective, the fundamentals of LIC are actually weak. And I'll tell you why I say this. This company has come to market where its business is completely matured. It's constantly losing market market share to the likes of HDFC and ICICI because their products are unique. Those companies are, far more advanced in terms of coming up with newer money back and endowment plans. We, as I said, few days before I came, 3 days before LIC was to list, I said that, we have a business vertical where we do distribution of third-party products. We've seen increasingly investors and, insurers looking at the likes of HDFC, which is constantly gaining market share, and ICICI, and shunning LIC because, the IRRs on policies of these private players is higher. So how can a company which is losing market share to private players have strong fundamentals and beat stocks of those companies which are anyways underperforming? So I really don't see why you would, I'm not surprised the stock is down about 25% as of today. If you look at the last 1 month since it's listed, in fact, less than 1 month. And I don't expect any significant jump up. Maybe the stock goes down another 10% and bounces back, or maybe it bounces back 5-10% from here. But that's not really a reason why you buy a stock. You buy a stock because you feel for the next many years there'll be growth, the stock would double and triple and quadruple. I don't see that happening. It's a completely mature business. There's nothing in LIC. So, no reason to buy it or hold it.
Okay, Rajat,